Hello everyone. Uh, so I'm going to teach you cost accounting. Myself, Rajesh Mane. Uh, in this session, I'm going to start with a topic which is introduction to marginal costing. Now, to start with this topic, you need to first understand what is marginal cost. The change in the total cost that comes from making one additional item or producing one extra unit. So marginal cost is a concept of economics that refers to additional cost which is incurred by producing one additional units of goods or services. So in simple terms, marginal cost represents the cost of producing extra unit of output. It takes into account the additional expenses required to produce that unit. Uh, Marginal cost is influenced by factors like economics of scale, availability, and the cost of resources, and the efficiency of production processes. Understanding marginal cost is important for the business in making production and pricing decisions. If the marginal cost is lower than the price at which the product is sold, product's additional unit can be profitable. However, if the marginal cost exceeds the price, it may be economically viable. It may not be economically viable to produce one more unit. So means we will fall into losses. By analyzing the relations between the marginal cost and marginal revenue, the businesses can determine the optimum level of production that maximize the profit. So this analysis is basically done in marginal costing. So marginal costing, with marginal costing, you will also have to learn two more costs, which is fixed cost and variable cost, which are the main cost in marginal cost. So let's understand what is fixed cost. The cost associated with the product that must be paid regardlessly of how much you produce or sell. So the cost associated with the product. So this is the cost which is already associated with the product that must be paid regardless. Regardless means we don't have any option. So whether we produce or we do not produce, we have to pay this cost. So fixed costs are the expenses that do not change with the level of production or sales volume. This cost remains constant irrespective of the level of output or sales. So if you produce one unit, you need to pay a fixed cost, and even if you produce 1,000 units, then also you have to pay the same fixed cost. It is important for business to understand fixed cost as they contribute to the overall cost structure and affect the determination of break-even point and profitability. So fixed cost is basically important to find out the profitability of the business. So by accurately identifying and managing the fixed cost, businesses can take uh, informed decisions regarding the production level, budgeting, and maybe the pricing of the product. Next cost, which is involved in marginal costing, is variable cost. The cost directly related to the sales volume and production. That means variable costs are expenses that change in direct proportion to the level of production or sales volume. So it is not like a fixed cost. As fixed cost remains constant, variable cost fluctuates on the basis of the quantity of goods or services which are produced. Few examples of this are material cost, labor cost, or selling sales expenses or selling. Now, these are basically the direct cost. Now, to understand or to know the concept of variable cost is important in business because they impact the profitability of each unit produced or sold. So by analyzing the relation between variable and revenue, businesses can find out contribution, which we are going to discuss ahead. And so the pricing, production level, and the resource allocation decisions can be taken by the company if you understand the variable cost of the company. Now, this is the structure, or maybe you could call it as a small cost sheet. Uh, it goes like this: sales. From sales, we deduct variable cost and we get contribution. Now, from contribution, we deduct fixed cost, we'll get profit. Now, we need to know what is contribution. So, this refers to an amount of revenue remaining after subtracting the variable cost associated with production or sales of goods or services. So, it represents the portion of revenue. So, it's not a total revenue, it's a portion of your revenue that is basically uh, contributes towards covering of your fixed cost. So, and it generates profit. So, this is the part of revenue which is remaining to cover fixed cost and it will generate profit. Now, contribution is given by a formula fixed cost minus variable cost, which will you will get contribution. If in a sum, if you don't have a sales and variable cost and the fixed cost and profit is given, then also you can calculate contribution. The second formula will be fixed cost plus profit, which will give you contribution. A positive contribution indicates that the revenue from the sales of a product exceeds the variable cost. And on the other hand, a negative suggests that the variable cost is more than the revenue, which will result into losses. So, if a business can improve their profitability by increasing the contribution margin, and this can be achieved through various strategies such as reducing variable cost, increasing selling price, production process, optimizing that production process, or maybe by identifying more profitable products, profitable product mix and all. Next is profit volume ratio. Profit volume ratio. Now, marginal costing is the ascertainment of cost as well as the effect of profit of change in value and the type of output. Now, marginal costing is ascertainment of cost, means you are going to calculate the cost over here, as well as the effect of profit of change in value, effect of profit, effect on profit. So, this will be an effect on profit due to change in value and the type of output. So, if there is change in the quantity or the amount of sales, the impact of or the effect on profit, okay, will be considered under profit volume. Such impact of change in volume of output, so if there is change in the quantity of an output on profit, the impact of this change on profit will be considered as profit volume ratio. So it is also known as profit volume ratio is also known as contribution margin ratio. This you have to note it down. This is very important because the other name for profit volume ratio could be contribution margin ratio. So it measures the relationship between the contribution margin and the sales revenue. So the formula for profit volume ratio is contribution upon sales into 100, and this the answer you will get in percentage. So PV ratio, profit volume ratio, you will get the answer in percentage. Now profit volume ratio helps the businesses to understand the impact of sales volume on profitability. So sales quantity, what is the impact of sales quantity on your profitability? So this is very important to go ahead and find out some other calculations in the business. The second formula which is given in this is profit volume ratio equals to change in profit upon sales, change in sales into 100. Just note it down. There will be different types of sums wherein we will in some sums we will use the first formula. In some sums we are going to use the second formula. At the time of solving the sums, I will tell you when to use the first formula and when to use the second formula. Next is break-even point. Now, the point at which no profit or no loss is there, it is called as a break-even point. So that indicates the level of sales at which the business neither makes profit nor it incurs a loss. In other words, we could tell that the total cost will be equals to total income. Your total revenue will be equals to your total income. That will result in zero profit. So at break-even point, the businesses cover all its expenses, both that is fixed cost and variable cost is covered by the business at this point. But this will be equals to total cost. It will not go above that. So it will only cover fixed cost and variable cost. No profit portion will be there. So zero profit at break-even. It is important milestone for a business to determine the minimum sales target in order to cover the cost and avoid losses. So this will be a point wherein business will think to target this point first, and then maybe if they achieve the break-even point, they will go ahead and will earn profit. So anything which is over a break-even point will be your profit. And if you are selling below break-even point, then it will be considered as loss. So break-even point, if you want to find out in rupees, the formula will be fixed cost divided by PV ratio, profit volume ratio. And if you want to find out the break-even point in units, the formula will be fixed cost divided by contribution per unit. Next is margin of safety. Now, margin of safety is the limit to which the actual or estimated sales exceeds the break-even sales. So this comprises of two parts. One is sales and break-even sales. So it represents the extent to which your sales or production can decline before the business starts incurring losses. So this is you can easily determine margin of safety. So this is basically safety is a buffer additional things which is over and above break even. So anything which is over and above break even will be considered as margin of safety. So margin of safety is equals to sales minus break even point. So your actual sales and minus break even point. Let's take an example. Let's suppose your actual sales is 50,000 and when you calculate your break even point, it comes to 40,000. So over here, break even point is 40,000. At 40,000, you are not going to make any profit. But if you go over and above 40,000, so whatever you sell over and above 40,000 will be considered as margin of safety. And right now, you are selling 50,000. So 50,000 minus 40,000, your answer will be 10,000, which will be your margin of safety. The other way to calculate margin of safety, the other formula which is given over here is profit divided by PV ratio, profit volume ratio. So it is worth noting that the margin of safety is based on certain assumptions such as fixed cost remaining constant and a linear relationship between your sales and cost. Therefore, it is important to consider the limitation of the matrix and conduct a comprehensive analysis of business financial position. Now, this is the additional formula which I am giving you. Now, sometimes the question demands a few calculations. So this a business can use to calculate the required sales when a company estimates they want to make certain amount of profit. So the profit is not an actual profit or the actual figure. This is an estimated figures uh, or estimated profit which they are assuming that they will make. So desired profit is given in the question, and you need to calculate the sales required to bring that profit. So the formula for required sales will be fixed cost plus desired profit divided by PV ratio, that is profit volume ratio. So if you go by this formula, you will get the required sales in rupees. And if you want the answer in units, your calculation will be fixed cost plus desired profit divided by contribution per unit. So this will give you the answer in units. So this is the first question. The question is calculate the break-even point from the following. Information given is selling price per unit rupees 40, variable cost per unit rupees 30, fixed cost is rupees 40,000, and it is also said if sales are 20% above break-even point, calculate the net profit. So two things to calculate in this. One is break-even point, and the second one is net profit when the sales are above break-even. So you are going to change your sales and bring it above break-even point. So first to calculate break-even point, then to calculate new sales, and with the new sales, we need to calculate the new profit. Okay, this is a small cost sheet which I have prepared from the question. So the sales given in the question is 40 rupees per unit. Variable cost, when we deduct 30 rupees per unit, we will get a contribution of 10 rupees per unit, and the fixed cost is 40,000. So with this, we need to calculate break-even point, and the formula for break-even point is fixed cost divided by PV ratio, that is profit volume. Now understand, uh, to calculate break-even point in this, fixed cost is already given in the question, which is 40,000. Total fixed cost is 40,000, whereas PV ratio, profit volume ratio, we need to calculate, it is not given in the question. So first we need to calculate PV ratio and then we will apply this formula. So for PV ratio, we require contribution, and the contribution can be calculated as sales minus variable cost, which will be 40 minus 30 rupees 10 per unit is contribution per unit. Your PV ratio is contribution upon sales into 100. So now you got your contribution as 10, your sales is 40 into 100. So your percentage will be 25%. Now, just remember, if the total amount of sales and total variable cost is given, we will get total contribution. And if the per unit is given, we will get contribution per unit. So, by any way, by either using the contribution per unit or by either using amount per unit, total amount per unit, you can get the PV ratio. So, either you can use total contribution upon total sales, or else you can go for contribution per unit upon sales selling price per unit. So, this is 10 divided by 40 into 100, 25%. Now, for break even, we have fixed cost 40,000, and even we got PV ratio, which is 25%. So now break-even point equals to fixed cost upon PV ratio, which will be equals to fixed cost 40,000 divided by 25%. Your answer will be 1,50,000. Now over here, note down this should be 40,000 divided by 25%. Normal mistake which is done by every student is they write fixed cost as 40,000 divided by your PV ratio is 25%. Not it is not only 25. So normally the mistake is done by the student is 40,000. They do it 40,000 divided by 25, which will give you a wrong answer. It should be 40,000 divided by 25%. Then only you will get your answer as correct answer. In this case, it is rupees 1,60,000. Next thing which they have asked me, if your sales are above 20% break even point, then what will be the profit? So first of all, we will calculate the sales, the new sales. The new sales is 1,60,000 plus 20%. That is 20% above 1,60,000. So 20% of 1,60,000 is 32,000. So 1,60,000 plus 32,000, your answer will be 1,92,000. Now, profit, to calculate profit, we can use this formula, sales into PV ratio. This is in bracket minus fixed cost. So first we need to solve the bracket. So in bracket, the sales will be, right now the new sales we need to consider over here, which is 1,92,000 into PV ratio, which is obviously 25% minus fixed cost, which is given in the question 40,000. So it will be 1,92,000 into 25% minus 40,000. So 48,000 minus 40,000. So your answer is rupees 8,000. So profit is rupees 8,000 when sales are above 20% above break even. Okay, so this is the second question. The question is, the following data relates to Messrs. Deepak Industries, and the data is fixed overheads rupees 2,40,000, variable overheads 40,000, sorry, 2,40,000, variable overheads are 4 lakhs, direct wages rupees 3 lakhs, direct material rupees 8 lakhs, and the sales given in the question is rupees 20 lakhs. And we are asked to calculate PV ratio, break even point, and margin of sale. Now this is a small cost sheet. Once again, I have prepared from the question. So the sales given is 20 lakhs, and direct material, direct wages, and variable overheads are the part of variable cost. So I have included it under the head variable cost. So direct material 8 lakhs, direct wages 3 lakhs, and your variable overheads 4 lakhs. So 8 plus 3 11, 11 plus 4 15. So total variable cost will be 15 lakhs. When we deduct variable cost from sales, that is 20 lakhs minus 15 lakhs, your contribution will be 5 lakhs. Now the fixed cost which is given in the question, that is your fixed overheads, are 2,40,000. So your profit will be 5 lakhs minus 2,40,000. Your profit will be 2,60,000. Now in the question, the first thing which we need to calculate is the PV ratio. The formula for PV ratio once again is contribution upon sales into 100. In the last sum itself, I have told you that we can take contribution per unit upon sales per unit into 100 for PV ratio, or else we can take total contribution divided by total sales. So by this table, we can get the contribution, which is 5 lakhs. The sales is rupees 20 lakhs into 100. So 5 lakhs divided by 20 lakhs into 100, your answer will be 25%. So our profit volume ratio Answer is 25%. The next thing we need to calculate is break-even point. The formula for break-even point is fixed cost divided by PV ratio. A profit volume ratio right now we have calculated, which is 25%, and the fixed cost which is given in the question is 2,40,000. So our answer will be 2,40,000 divided by 25%, and our answer will be rupees 9,60,000. So break-even point is 9,60,000. It means when you do a sales of 9,60,000, your profit will be zero. So it is break-even sales. The next thing which I have asked in the question is margin of safety, which is the difference between your sales and break-even point. So the actual sales given in the question is 20 lakhs, and the break-even point which we recently find out is 9,60,000. So 20 lakhs minus 9,60,000, your answer will be rupees 10,40,000. So your PV ratio is 25%, your break-even point is 9,60,000, and margin of safety is 10,40,000. This is your answer for the question. Now coming to the next question, the third question. Now this is a different variety of sum wherein you will not have a much data given in the question. It will only comprises of 2 years sales and 2 years profit. Uh, Understand, some questions will contain sales and cost, and some question will contain sales and profit. For the solution, we required sales and profit for that particular year. So the question is, from the following particulars, you are required to calculate PV ratio, that is profit volume ratio, break-even point, BEP, profit when sales is rupees 2 lakhs. So when the sales is 2 lakhs, what will be the profit we need to calculate? Next is sales required to earn a profit of rupees 40,000. What will be the sales if we want to earn rupees 40,000 as profit? Last is margin of safety in the second year. Okay, so not for the first year, we don't need to calculate margin of safety for the first year. Only second year calculation is required. Now, whenever you get this kind of sums, uh, if you remember, I have given you profit volume ratio, two formulas. One is contribution upon sales into 100. And the second formula I told you at the time of sum, I will clarify when to use this formula. So change in profit divided by change in sales. So when the data is given for the 2 years and this much data is available, so in that case, you can use that formula, change in profit divided by change in sales into 100. Now coming to the solution, the first thing which we need to calculate is PV ratio, profit volume ratio, and it says change in profit divided by change in sales. Now the change in profit means the difference between the profit which is given in the question and the difference between the sales. So the difference between the profit is 26,000 minus 18,000. So second year minus first year. Change in sales is 2,80,000 minus 2,40,000. Over here also second year sales minus first year sales. So it will give you an answer of 20%. That is 8,000 divided by 40,000 into 100. So answer is 20%. So PV ratio comes to 20%. Now the second thing which we need to calculate is fixed cost divided by PV ratio. So if you remember in our question, uh, profit and sales, these are the only data which is given. There is no fixed cost given in the question. So to solve this break-even point, to calculate break-even point, we required fixed cost and PV ratio. PV ratio we got 20%, fixed cost we need to calculate. So first we'll calculate fixed cost. Now to calculate fixed cost, we'll use the formula sales into PV ratio minus profit. Now in this case, the profit of both the years is different. Profit of sales is also different. The PV ratio for both the year is 20%. Now you can use any one year and you can solve that. So in this question, I have used the first year profit and first year sales. So if you are taking sales of first year, you have to take the profit of first year. If you are taking sales of second year, you have to take the profit of second year. So both the data should be from the second year or first year. So in this question, I have taken first year profit and first year sales. So sales for the first year is 2,40,000. PV ratio is 20% minus the profit for the first year is 18,000. So this will give you 48,000 minus 18,000 and your fixed cost is rupees 30,000. So by this we got fixed cost 30,000. Now to calculate break even point, we require fixed cost divided by PV ratio. So fixed cost is rupees 30,000 and PV ratio is 20%. Both the data we have got, and now the solution for break-even point will be rupees 1,50,000. So when you do a sales of 1,50,000, your profit will be zero. That is at break-even. No profit, no loss. The next thing which is asked in the question is to calculate profit when the sales is rupees 2 lakh. So sales is given. Now this is not a first year or second year sales. This is the new sales which is given in the question. So they are asking if you want to do a sales of 2 lakh, what will be the profit? So let's suppose sales is 2 lakh. We will use the formula for profit. Profit equals to sales into PV ratio. So now when you multiply sales into PV ratio, we'll get the answer as contribution. And you know, contribution minus fixed cost is profit. So sales into PV ratio, sales is 2 lakh into PV ratio, question may have 20%, which is 20%, minus fixed cost, which is given in the question is 30,000. So 2 lakh into 20% minus 30,000, it will be 40,000 minus 30,000. Answer is rupees 10,000. So your profit comes to 10,000. So when you do a sales of 2 lakh, you will get a profit of 10,000. Next question is sales required to earn profit of rupees 40,000. So if you want to earn 40,000, if you are estimating your profit should be 40,000, then what sales you should do? This is the meaning of this question. So to calculate this, the formula is, now if you remember, we have discussed required sale formula, which is the same formula. So the required sales is equals to fixed cost plus desired profit divided by PV ratio. Now fixed cost we have calculated, which is 30,000, plus desired profit in this question is 40,000 divided by 20%. So 30,000 plus 40,000 divided by 20%, your answer will be 3,50,000. So this is your sales. When you do a sales of 3,50,000, your profit will be 40,000. Now they have asked the margin of safety. Now the margin of safety, uh, understand one thing. Uh, the question there is 2 years sales and 2 years profit. Now if we question demands for break even point, now they have not mentioned whether we need to calculate break even point for the first year or for the second year. We have randomly taken a figure and we have solved it. The reason behind it is the break even point formula is fixed cost and PV. So fixed cost irrespective of whatever sales, whatever profit, fixed cost is same. So it will not change. So fixed cost is 30,000. Whereas PV ratio is same for both the years, which is 20%. So break even point for any of the year will be same. That is 1,50,000. Now for margin of safety, actual sales minus break even point. So now the sales are different in this question. So first year the sales is different. For the second year the sales is different. So first year sales is 2,40,000. Second year sales is 2,80,000. But the break-even point is same in both the case, which is 1,50,000. So the question will demand for margin of safety of any one of them. So understand one thing, children, ki if the question does not mention for which period you need to calculate margin of safety, you need to solve the answer for both the years, for both the periods. So now in this question, they have demanded for the second year. So question demand for the second year margin of safety. So we'll take all the data of the second year. So second year sales is 2,80,000 and your break even point is 1,50,000. So your margin of safety comes to 1,30,000 rupees. So this is the answer for the given question.